Today we're going to talk about 50 pips a day. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacy Burke from Stacy Burke Trading. Wednesday, US election results starting to come in and get counted. Exciting times. Lots of volatility starting in the markets already this morning. British pound and gold going crazy. Yesterday, a very productive day, and Monday as well. We had some textbook perfect trade setups yesterday, some very big moves. Today we're going to be reviewing the 12 candle window. We're going to answer a lot of questions. We're going to hit on some hard-hitting subjects and face some realities about trading. So let's get started. First of all, we're going to talk about trading as a skill. And before I do that, I just want to say thank you. A ton of great feedback. And again, yesterday, some traders have sent me some screenshots. Pound Aussie, pound. We had day zero on Monday on the pound. We had a screaming trend day yesterday. Gold, three sessions. 3 major moves, lots of great trades. Some traders have killed it. And again, thank you for hitting the like button. Turn on your notifications. When I make a new video, you'll get that as soon as possible. And for those of you who I haven't gotten back to, I apologize, but I will keep trying to get through the emails. I've just got a massive box full at the moment with screenshots and everything else, so I apologize, but I will get back to you. Pete in the Netherlands, I'm gonna get to the charts that you sent me. So, trading is a skill, okay? I want to hit on this really hard today because I think there's some traders out there that need to face the reality that you are in an environment, in a market where you're going to the screen and you're getting emotional, you're getting angry, you're getting upset, and you're getting frustrated. But you're up against the best people in the world. You're competing for money. And there you are, you're throwing in the towel and getting mad and saying it doesn't work. But the reality of it is there's 50 pips every session on some of these days. So you need to face the facts about developing your skills. I talk about this in the 7-step daily routine for high performance traders. You need to create rituals and routines and habits that are going to bulletproof you for success, moving in a direction of constant progress, 1% better every single day. Are you going to the screen hoping that you get the right move, or do you have a plan of attack that you expect? Maybe a stop hunt down for a long trade, or a stop hunt high for a short trade, or is it a trend trade? What is your preparation and your routine like going to the screen? If you don't understand exactly what you're doing, then sit back and observe, make a thesis, make notes, watch and learn. The market will be here the next session, the next day, the next week, the next month. It's not going anywhere. These rules apply on any market. There's variations in terms of spreads, volatility, amount of movement, all those things, which is why I primarily focus on the British pound, USD, pound Aussie, and gold, because the spreads are usually consistently tight on the 15-minute charts, and they have lots of movement, and day in and day out there's 2 or 3 really good 50 pip trades. So it's important to have a perspective on what it is that you're trying to accomplish, and also understanding that trading is a business. All this rubbish out there about currencies trend and they do this and they do that. Well, if you've been following me long enough, if it was that easy, everybody would just be trading currency and making lots of money. Well, it's a skill. It's a performance skill, like being a professional athlete. Lots of people want to be professional athletes. There's lots of great athletes out there. There's lots of people that work hard that never make it, that are talented. There's lots of people that are talented that work hard that do exceptionally well. And then there's people that work hard and develop the talent and are relentless at the pursuit of getting better, that over the long term can carve out a very successful career. So I can't apologize to anybody for getting frustrated by going to the screen and trying this once or twice and then getting mad and throwing the towel in. It's a skill, and this is not a theory. Markets work from highs to lows. The smart money in every market works from the top and the bottom. The retail money works from the inside, chasing what they perceive to be the move. And sometimes they are in the move, but over the long term, they're going to get chopped up. So it's a skill. develop a routine, a training program, a method for evaluating and improving on a daily basis. The next thing I want to hit on is that the market doesn't care. The market doesn't care who wins the election. The market doesn't care what school you went to. The market doesn't care how bad you need the money. The market doesn't care whether or not you had a good trade yesterday or a bad trade yesterday. The market doesn't care about your sexual orientation. It doesn't care if you're a man or a woman. It doesn't care if you're a child or an adult. It doesn't care if you've been studying the markets for 40 years. It doesn't care. What matters is that you are at the screen controlling the controllables. You cannot control what the market will do, but you can control your approach and your tactical methods of approaching the market, managing yourself in live time, which is our next component relating back to this. It's about live time performance. Your preparation, your planning, and your execution all is about what you're doing in live time, not about what your system backtest results are or what your thesis is on the market. It's about what you're going to do in live time. Are you going to get mad and take impulsive trades? Are you going to average into a losing position to try and get back to the high water mark? Are you going to get in early? Are you going to chase a move? Are you going to hold on to a loser? Are you going to hold on to a winner too long because you had a profit target plugged in, but then you thought, oh, it's going to go further, only to hold on to it and get nothing? These are all the things that will happen to traders in live time that separates trader A from trader B. Same system, same methodology, completely different results. One keeps system jumping and looking for the solution in the entry-exit model. The other trader does the work on honing their skill set, managing their emotions, having a practical approach to their mechanical model, and implementing it and then mastering their craft. So these are all the critical aspects that separate winners from losers and consistent traders from inconsistent traders. So again, the market doesn't care. I had a shirt on a few weeks ago, no excuses, which means I take full accountability for my trading results every single day, good, bad, or excellent, or poor, whatever they may be. And I'm constantly talking to myself. I talk about focusing in on 12 candles, knowing exactly what you're looking for. Are you at the high of the day? We talked about mean 25 and 50 pip increments away from the median price. So we're going to get to that in a second. But you need to be able to manage yourself. You need to wear all the hats. You need to be the risk manager, the trader, the office manager, the business manager, all at the same time. And if you're not able to do that, if you're going to the screen going, I hope I catch a move today, it goes one way and you chase it the other way, you get stopped out, you throw up your hands and say, this is ridiculous. The trader who's prepared goes there knowing exactly what he's looking for, how he's using time and price to his advantage. And we're going to talk about algorithms in a second. So make sure you are prepared. US election. Biden, Trump, doesn't matter to me. I know we're going to get volatility. I know there's going to be 50 pips today. I have my own opinions about the election, but they're irrelevant. You know what they say about opinions? They're like, everybody's got one. Managing emotions. How do you manage emotions? Well, my attitude on emotions is this. If you're bringing your emotions to the market, you're already doomed to fail. You have to get your application so airtight in terms of your execution, whether you use the steps that I go over, that I use, or you have another method, whatever it is, your emotions have to be at the door. You're running a business. You have to get in the headspace of understanding that you're running a trading business. If you have edge, and you have edge over a larger sample size, then you know that your job is to execute your edge. Win, lose, or draw, you execute your edge, you reevaluate, you manage, you review how you executed that process over that sample size. And if you're going to the screen and you're emotional, you're going to lose your money. So stop trading, start again, have a plan each time you go to the screen. As a retail trader, that is one of the tools they will use against you, aside from the manipulation of price and the mechanical impulsing of the price, the speed, all of those things which are designed to entice you and scare you out of winning positions, trap you into losing positions, all the little things. But unless you've spent the time at the screen and being in live time, like a professional athlete, practicing their skill is one thing, perfecting it and executing it in a live performance venue is another. So emotions are things that you'll need to go through and deal with. Journal them, find a new plan or routine, and so that you're not, if you have triggers, so people will say, well, how do you manage your emotions? Well, we all have different reasons that drive us when we're trading. And as I mentioned, if you're trading out of desperation, you might as well just stop trading until you master the craft in demo time, because if you're desperate, you will do things that will destroy your account. They'll destroy your ability to perceive data in live time with an unbiased perspective, to be able to just execute and focus purely on mastering the craft of executing your trading process. Emotions and trading do not go together. Now, I know that it's hard not to be emotional. Of course, there is a part of everybody who's trading their own capital that's going to have an emotional response attached to the outcome. But that's to the detriment of you as a trader. So that comes back to how much risk are you putting on in the trade? Have you put your playbook together? Have you designed your set? Do you know what your setups are? Do you know all the incremental little breakdown of those setups, the different variations of how the price action may present? If it's a buy low signal or a sell high signal, or if it's a trend day, what are the different variations that you're familiar with? And know every single little aspect. You are up against the best people in the world, the brightest minds, the algorithms, the quants. They have all those things configured into their systems. And if you're trading, a discretionary trader, trading in that environment, you are in the big leagues. If you don't want to put yourself into that environment, you want the rewards, you've got to put the time in and pay the price. But my advice to all the people out there is, do not throw your money away. Make sure that you are mastering your craft. The money will always be there if you have the right perspective and you master your craft and you focus on growing your trading account rather than how much can I make today. And then that's what ultimately leads to blowing up a trading account. I've talked about doing that in several occasions. So I read an article yesterday, algos and electronic market making in currency markets is responsible for at least a minimum of 80%. Now I talk about focusing on the timing window. Don't worry, I'm going to step aside. You're going to get plenty of screenshot of the board today. But I want to emphasize, I talk about, just to go back to the timing window. People keep emailing me, asking me if I've changed my times. I'm not changing anything. I work on New York time. 8 to 11 p.m., 2 to 5 a.m., 8 to 11 a.m., New York Eastern Standard Time. I don't care when Tokyo trades. I don't care when Sydney trades. I don't care when Frankfurt opens. I don't care when Singapore opens. That's the times that I go to the window. That is my 3-hour window, my 12, 15-minute candles, not 12-hour candles, not 4-hour candles. I don't look at anything else. That's my window. That's the time. I use New York time. That's it. Nothing else. So if we're up against algos that are driven specifically, now let me explain something about what I read in this article. They are up to the second computationally always trying to balance their hedge and their buy-sell ratio so that they are neutral. They make their money from the spreads and from the losses of traders. So if they're constantly balancing their book electronically because they have all that instantaneous data going through those electronic market makers, and there could be coercion, there could be multiple banks working together, I have no idea. But if that's the case, and I know they're going to move it in those 12 candle windows, which if you've been following me long enough, you know they move these and it's almost like clockwork. Within the first few minutes of that 12 candle window, take a look at your charts, you'll start to see the price action happening, whether it's a stop hunt, it's a 1, 2, 3 stop hunt, or if they've already had this stop hunt and it's a breakout for a trend or a stop hunt in the other direction. So When you understand that these markets are potentially maybe even more than 80% electronically market maker driven, that's like playing chess against a computer. It has every single move configured, which is why, coming back to the whole premise that I work from, is that I work from the high and low of the day, because those are the areas where I can control my risk the best, and I have asymmetrical risk reward. I'm going to risk one ATR for 3 or 4 or 5 or 10 times what I'm risking. If I'm inside chasing moves, I have no idea where my risk reward is going to be targeted, where my measured moves could be, all of those things. So high and low of the day, because that's where the money is, that's where the stop losses are. That could be the high and the low of the previous session, depending on how that's traded. If it's a breakout, they might have a stop hunt back into the traders that are already in profit before they continue that move. So you'll need to print off your charts, study those different scenarios, and each day, again, understanding even in the weekly template, where we might get 3 days up, a day sideways, and a day down. We see that even within the daily cycle. We see it within a session cycle. Well, yesterday, gold, 3 sessions. 50 pips in both directions. 50 pips up, 50 pips down. 50 pips down, 50 pips up, 50 pips up, 50 pips down. That's 300 pips in 3 sessions. So, timings. Trading outside of those other times, to me, is 50-50. And I'm sure, because people have emailed me and told me they get caught into these false moves, and next thing you know, they're caught sitting waiting until the next 12 candle window starts, and then bang, there's a stop hunt, and they're either caught in the wrong direction or they have to sit and wait, and then they just try to get out at break even. So again, these are the things that I can't control for you. If you're taking other trades or you're getting in and you're just hoping that it's the right trade, I can't control that. I talk about 2 scenarios, engulfments and pin hammers. That's it. That's all I'm looking for at the high or low of the day. That doesn't mean that I can't take a pin hammer at the high of the day in a trend trade like yesterday on the British pound. If it's a trend day after a day 0, I'm not looking to counter trend. I want to trade with the trend, and if the first bar is a pin hammer, I'm taking it. That's a 1 bar stop, and I'm looking for a measured move. Little simple things. Median price. Coming back to understanding when the market opens, if we're in consolidation, that 25 and 50 pips away from that area may be where that stop hunt or movement occurs. Yes, it is tradable if you're already in the move, because understanding that in that first hour we may have a 25 to 50 pip stop hunt to the high or to the low of the day, or into a previous day's range. But it's the equities hour that I'm targeting, unless I get a first bar entry, which typically will come, as I told you yesterday, and I keep saying this, with a 33 type setup. The third push, and then a 1, 2, 3, where we go 1, 2, 3 in that first hour, heading into the equities hour. Sometimes we saw a great 1, 2, 3 on a third push against the trend yesterday on gold for a 50 pip stop hunt in London to the open of the equities hour, a 1 bar engulfment, and a 100+ pip move back up to the other side. The bullseye hour, that's what I'm targeting, is that equities hour, especially in the New York session. In New York, they will often move the market in that first hour, up or down, one way or the other, and then in that equities hour, they may, in that first 1 or 2 bars, take them into the extreme a little bit more before engulfing and reversing and coming back for the move in the other direction. Whoever is in the money in that previous session will typically at least get stopped out at break even. Yesterday was a trending day on the pound. When you understand the trending days, you know they're not coming back. You do not want to counter trend on a day 1 after a day 0. We talked about the narrow range day. We had the peak formation low on Monday, and it was a golden setup for traders for a straightaway trade into the Europe-London session. When to scale? Great question. This is what I say. When you get results, do 10 trades at a time. Get results. Get consistent. Bump it up a little bit. Do 10 more trades. Monitor your results. Are you taking other trades in between, or are you executing your trading plan flawlessly and then getting consistent results, whether it's 60%, 80%, 90%. Maybe you got 10 out of 10. bump it up in size. Don't take 3 winners and then say, man, I'm loading the boat, and then you blow at everything you do and you go backwards. Scaling is about your results and your consistency in your execution of your trading plan. If you don't have that, even if you had a big winner, you need to be realistic and honest with yourself. Are you executing your trading plan? That's what matters. If you're doing this right and you're getting the results in terms of your profit loss and your consistent hit rate and your 50 pips, your profit target, are you going for 50 and taking 25 out? Or okay, how can you get better? Get really good at executing your trading plan, monitor your results, bump it up in size, do 10 more trades, just keep going. Scalability is based on how well you're performing. So if you're performing well and you're doing everything right, bump it up a little bit in size. The compounding effect kicks in very quickly if you're doing things right and you're patient. You don't need to rush this. Okay, so what are your best setups? If you're not sure, print off the last 3 days on the pound Aussie, gold, and the pound. Textbook perfect setups. High and low of the day. Monday on London was the same trade as Friday on London, just a different variation. The equities opening candle on Friday, 50 pips up, low of the day. Monday, the 4th candle of the equities hour on a 50 pip stop hunt for a 50 pip move back up. Textbook perfect trades. Gold, we've had some just perfect setups, but what's really important, and I talk about this, is using time. Understanding time. When you understand the timing, these trades make sense. If you're using just price and focusing on what you're looking for and chasing the moves, you're going to constantly get confused and you won't be able to get consistent. The timing is where the consistency will come and tie this all together. Plan and prepare. So coming back to what we talked about, don't be going to the screen and again, I talked about getting people sending me screenshots with all these indicators on there. You don't need that. If you're getting results using that, then use it. I'm never going to tell people how to do that. But my big challenge with using indicators is that you'll never be able to consistently assess a situation the same. The indicators will give you analysis paralysis. Is it time yet? I'm not sure. The EMAs are down, but that we're at the low of the day. I'm not sure if I should buy that, or the trend's down. I can't buy against the trend. And then you watch it go 50 pips, and you sit there scratching your head, going, "But how did that happen?" The indicators will cause you confusion and frustration. If you want to use them, go ahead. Plan and prepare. I have a very, very simple model. Timings, high and low of the day. Do we have an area of trap volume? Are they caught in a 25 pip box at the high of the week or the low of the week? Or is it whipsawing back and forth? If we're whipsawing back and forth, like today we've got some big volatility, I'm waiting. I'm going to wait. I'm going to wait until it's at the high or low of the day. And I'm talking about the session, because there's going to be a move. They've already been moving it all over. And again, coming back to the fundamental premise, nobody gets a free lunch. There's money sitting at the highs and the lows. So when the timing window kicks in, I'm looking for a stop hunt to the high or to the low. I'm looking for an engulfment and pin hammer. It might be a second leg for an M or a W. So these are the little things, but I'm going to work from the extremes because my risk is very controllable there, and I can target asymmetrical risk reward. Okay, round numbers again. Pound, gold loves double zeros, 100 pip boxes, but 50 pip increments and double zeros. So I'm always looking, which 50 pip box am I in? Where's the median price? If I'm between 25 and 75, the median price then is going to be double zero. If I'm between 0 and 50, my median price is going to be 25. Often you'll find that median price is where the market starts just prior to the 12 candle window, unless we're at round numbers. And then we go back to understanding that they will do a 25 to 50 pip stop hunt on average as we head into that next hour. If they don't, if there is no movement in that first hour, we can possibly expect that breakout or movement in that equities hour. Now, if you're already in the market, as we get towards the end of that hour, you may be looking at taking profits off or moving your stop to tighten up profits or to trail a move, because as we get closer to the end of that hour, that is where we see the highest possibility of the market reversing. Now, I'm not talking about a market that's already had a trade. I'm talking about when they initiate the stop hunt, either in that first hour stop hunt trap, or if they go into consolidation and stay there and then break out in that equities hour. So if you're not in that move, you think you've missed it, but actually we're going to see that market come back, because again, nobody gets a free lunch. Now, understanding the difference between a market that is already in trade versus a market that is in a stop hunt, because if you're trying to counter-trend a market that's already in trade, you're going to get smashed. So round numbers. Engulfments and pin hammers, again, print off your charts, study the highs and lows and the timings. It's all there on your chart. So if you can't see mine on my screen capture, which by the way, my camera is 1070 and so is my screen video, so I keep trying to make it clear. It looks clear on my YouTube. I know traders are frustrated, but that's it. That's my camera. This is the information. Get your charts out. Go through your charts bar by bar and study it. Look at what time it is. How did it occur? Was it an engulfment and pin hammer? I guarantee it's going to be in the 12 candle window. If we go outside of that slightly, that means we've just had a 3-push pattern. 3 hours, 3 pushes. So we're going to get an M or a W for a squeeze for a 50 pip or more move in the other direction. The longer the move, if it's a creeping trend inside of the 12 candle window, you're in a squeeze setup. If the market has already had 3 pushes heading into the 12 candle window, we're going to get a blow off with the direction of the creeping trend or a stop hunt in the other direction. It's as simple as that. A 1 ATR stop, 50 plus or minus pips profit target, depending on if we've hit the high of the day or round numbers, or if we're in a measured move for 100 or 150 pips, as we saw yesterday on gold and the pound. Plan, prepare, and execute. Evaluate yourself and improve. There's no free lunch in this business. It's a business, and it requires you to work at it. If you want to get better and you want to be good at it, even when you're good, you still have to work at it every single day. As Peter Brandt says, you can blow out 40 years of good work in one day by going into tilt. I know we talked about this a few videos ago about a trader in Toronto who talked about losing $27 million in a day. So you need to do some work to work on the little things that will help you go to the screen to be at your best, and then mastering your tactical approach, managing your emotional state. These are all the things that I've had to learn the hard way through painful lessons, and going back and doing things and getting beat up again and just going back, which is why I talk about carving every single thing back so that I can go there and just focus on a couple of simple things, and also be okay with walking away if I didn't get a trade, or if I took a trade that was maybe the wrong one out of the 3. Sometimes I just will only take one. I like to focus on one trade. Maybe I get stopped out, but I'll come back, and I've talked about focusing on ending the day green. There's 50 pips almost every session when I include gold and the pound Aussie with Asia. So it's a winnable game, but you are in the most fiercest environment in the world. It's about money. It's a zero-sum game, and it requires you to do the work. So hopefully you got some value out of today's video, traders. As I said yesterday, trade smart. Always act in your own best interest. Frustrated, angry, get up, walk away, clear your head. Do all the things that will allow you to continue to get better. Don't beat yourself up psychologically. Don't do things that are going to damage you psychologically as well as financially. It's a winnable game. Keep it simple. Let's look at the charts from the last couple days. Today we've already seen massive volatility. Next couple days we'll find out who the president is. Stay disciplined, stay focused, keep getting better, do the work, and win this game. Have a great trading session, and may the markets go with you.
Good day, traders. Continuing our discussion on 50 pips a day and the 12 candle window, and we're looking at the British pound from Monday, day 0 scenario. We had a peak formation and the narrow range day after Friday. We talk about Friday, Monday, Tuesday being the most common days for day 0. The day 0 is where we potentially can have an explosive trend day come out of that. But just coming back and reviewing our 12 candle window, and again, I don't trade the pound during the Asian session, but just talking about the high and the low of the day. So we have our first hour, 4 bars. The market is in consolidation. We had a 1, 2, 3 up inside of the trend. So we're high of the day, low of the day, we're inside. The market breaks out in the beginning of the equities hour. 1, 2, 3 down, a little pin hammer on the last candle of the hour. And again, traders perceive this, that they miss the move. They get mad. They get frustrated. People email me and say, I missed that trade. But this is a 50 pip stop hunt, 25 to 50 pips outside of the Asian range. So the high and the low are here, but in the consolidation, we have a range now at the bottom of the 00 box. They break out and go down to the bottom of the 50 pip box. 1, 2, 3 pin hammer. This is a 1 bar stop. And the market immediately comes back to the redrawn high of the day, which is now the swing high of the Europe-London 12 candle window. So again, on Friday, we see the first hour stays inside of the low of the day. They pin up into the move that came down from the Asian session. But the first candle of the equities hour is a pin hammer at 00, stop hunting into the peak formation from Thursday. So again, similar trade, first candle for the move back up to the high of the day, just a subtle variation. They went 25 to 50 pips out of the box, in this case, gave the pin hammer 50 pips below for the move back up. Different variation, equities hour, pin hammer, off the numbers for the 50 pip move back up to the high of the day. Yesterday we see the market trade sideways. So again, median price, we're in a 50 pip box. The median price is 25. We come off the day 0 scenario. The market works off the low of the 3-hour 12 candle Asian window. Heading into the Europe window, we've not triggered the previous day's high, which is almost also potentially a giveaway, because the market's consolidating underneath before breaking out in that first candle of, the last candle of the equities hour, and then exploding after the first candle stays on top of the previous day's high for the open drive and the continuation of that move, which again, we'll look at the measured move range expansion. Okay, so if we take a look at just putting our measuring tool again on that day 0, because again, we're in a rectangle, so talk about structure, we talked about structure. Structure, our day 1, day 0, we come out, we break out of that market. So again, understanding the difference between a breakout versus a stop hunt. This is our first hour. Then in the third candle of the first hour, they break out, they consolidate at the high, and then open drive candle. So we get one full expansion, and then this morning they complete a second full expansion of that range, an engulfment at the pin at the high just prior to the beginning of the Asian 12 candle window. This is the pound. Obviously, the election results are having this effect, but also understanding now, if you're trading this, so now we have our pre-market hour, the first hour. We want to be trading in the direction of the existing trade. So this is a short sell at the high of the day, the high outside of the high of the previous day, but also now we have 1, 2, 3, 4. We have a little bullpen hammer, the break of this candle at round numbers at the quarter level for a measured move down possibly. So we could see this market continue down to the low of yesterday as a full expansion. We'll put the measuring tool on there. And again, this is only just giving us, if you understand that these markets potentially are algorithmically driven, we could be in a mathematical expansion of one full extension of this range. Mathematics, they break out, they continue for a measured move. Not to say that that's what's going to happen, but there's a high probability or possibility that we may see an extension that's 50% of this whole entire range from top to bottom. So again, looking at the pound Aussie, we have Monday, again just coming back to our 12 candle window. We have a high and a low in the market is inside as the 12 candle window prints in Asia. They stop until the low of the day and go into consolidation. But we have our high of the Asian session intact. They stop hunt to the high of that range just prior to the 12 candle window, pull back, go sideways in that first hour for an open drive, which again, difficult, emphasizing that not all of these moves are potentially easy trades, but understanding that if the market has set up a certain way or hit the high and low, we may also be in a market that, even though they've made you chase this, it's an open drive candle, we can be in a measured move now of this bull candle in a downtrend. We see one full expansion, which again is a 50 pip move, and we want to be trading in the direction of that engulfment of the large bull candle. So the market in the equities hour now has broken out of that range, pulled back, and continued the move. We're heading into the U.S. session. We're continuing the move. So we want to have our bias in the direction of the existing trade. But we head into yesterday's session, a 75 pip move up in Asia. So again, 25, 25, 25, 3 levels of rise. At the end of the 12 candle window, we get a 1, 2, 3, taking it 25 pips outside of the Asian range for the engulfment, the consolidation, and the continuation of that move into the 12 candle window. So again, using the pin bar as a flip zone for a potential measured move. So if you're not familiar with this, pins can become a flip zone. Go and do your homework, study the charts, go and study what a flip zone is. If the market, this entices traders to want to chase that move long, thinking that this pin bar now is a long entry. But when they reverse this, we could do one full expansion of that complete structure now, that one complete structure as a target. Just one complete structure of this peak formation and the pin. But I typically will look for 2 times the pin as an extension of that range as a target. But we head into the 12 candle window, and we also now have structure from the high and the low of the day for one full expansion of that range. So again, depending on the timings of when this market, again, we get to the low of the the London session, we're in consolidation. The market stop hunts in the first hour back inside of the trend. We have lower highs. You want to be thinking lower highs means traders chasing the move down lower, which means that we'll potentially get a stop hunt back through these lower highs because all of this volume is trapped. And that's why these markets move 1, 2, 3, 50 pips, because they want to move quickly to stop out traders who are in the existing trend, especially when they're down low. So timing window, you can be in these moves, everything else, but when the timing window is about to kick in, you want to be taking profits or looking for the entry for the trade that's about to trigger in the 12 candle window. We see the consolidation this morning. Obviously today with the election, we got lots of volatility and pins. Just again, but 1, 2, 3, 4, and then the first candle of the equities hour, an engulfment of the little doji pin for again a 1 bar stop and a 100 pip target. Back up, getting traders who are in the money from yesterday's 12 candle window and above in the London session. Where is the money? Who's in profit? These traders are. Guess where they're going? This is a big consolidation. That's a coil. Boom, explosive move. 3 bars, 100 pips. Just having a thesis each day. Where's the consolidation? Is the trap volume down low or is it up high? Are we down low? Where's the coil? The indicators would all be having you selling this. This is a squeeze, an explosive move back through on the lower highs, trapping traders that are down low but stopping them out with a loss and getting traders who were in the money. So gold, a classic. Yesterday we had a 50 pip move up right off the start of the session, a creeping trend down. Shorter time frame, we see again this was a creeper back into an existing peak formation. They went 50 pips up, consolidation sideways. A 50 pip move from the M structure down, but not 50 tradable pips, but 50 if they held on to it. But the consolidation, we had 1 push, 2 pushes, and then a 1, 2, 3 back into the short move. Then we get the 50 pip stop hunt down through the low of the day, and then the engulfment, which again on not all charts are going to be the same. On my other platform, this was an engulfment, But we had the open drive candle on the equities hour, so even if you took the equities hour candle, again, a 1-bar stop, and the target, the thesis being at least the high of the day, but also potentially a measured move of that range back. And the market it behaved as it should have. It layered on top of the Europe-London 12-candle window, and then broke through to the high of the day, which again worked the high of the day and broke out and continued to gain into the U.S. session for pulling back and working the high 3 times, and then extending that move into this morning's rollover session. So 12-candle window. First hour typically will possibly be the trap and the stop hunt in one if it's just a consolidation. But an example again, low of the day, high of the day. Low of the day, high of the day. We go into the next 12-candle window. We're in trend. We're at the high of the day, but we get a pin hammer as the first candle in a market that has now layered on top of the high of the day. Okay, so we're looking for a continuation move. 1-bar stop, 50 pips, you're done in 45 minutes. So keep it simple, traders. Stay focused. If you're not sure what you're looking for, watch and learn. Have a thesis, watch the market, but don't throw your money away. 1-bar stops, high and low of the day, 50 pips, measured moves, 1, 2, 3s, same thing over and over again. This morning we see the same thing. They went up 1, 2, sideways 3. Again, I've talked about the Euro Great Britain scenario. I'll talk more about that later. We get the engulfment of all of this volume in 1 bar. We get 1 hour of volume trapped up top, 1 bar. I mean, obviously today with the volatility, that's an exception, but it's the same thing. Volume's trapped up here. They go sideways, 4 bars, engulfment for a 200 pip move down. So there's opportunities everywhere. Today, obviously, we want to manage our downside. There's lots of volatility. I'm going to be probably observing and watching unless we see things kind of stabilize. It's not worth throwing your money away or taking 50-50 trades. Wait for the 90-10 opportunities. Stay disciplined. Stay focused. Do the work that's going to keep getting you better. Plan your trades. Prepare properly. Go into each session knowing that you're on top of your game. Have a great trading session, and may the markets go with you.
Hi traders, it's Stacy Burke from Stacy Burke Trading. If you haven't done so, please head over to my website at stacyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.